I say many times over that this year has been complete and utter hell, right? And that sounds like a strange statement because it's like, all right, so what, the S&P's down 10, 12, 13%, depending upon the day that you're looking at it year to date, here in August of 22, late August. But, the reality is it's more than just the stock market. You've got insane volatility going on in currencies. You've got insane volatility going on in the bond market. And stocks are just, at least for now, sort of, kind of blah. It's some days down big, some days up big, but for the most part, it's, looks like to an outside observer, just like a run-of-the-mill correction. It really isn't, right? The amount of damage that's happened underneath the surface is severe, and the amount of movement outside of equities, I think, will have ramifications on equities. So that's a long-winded way of basically saying this year has been brutal in a lot of ways. I myself run risk-on, risk-off funds that rotate around either equities or high-yield debt, or go all into treasuries. And candidly, I've been really nasty hit in this environment, going through a drawdown across the board and everything, because treasuries are having one of their most severe bear markets in history, one of the biggest yield spikes in history. All this despite fears of recession, which tends to be bond bullish, or at least treasury bullish. So I believe that we are in an anomaly. This is one of those times in history which, across the board, no matter what data you're looking at, there's nothing really in history, even in the 70s, that you can point to in the way asset classes are interacting with each other. The good thing about anomalies is that they likely end, right? Because it's just a single data point in a moment in time, which is very painful, but is a very small period in the context of longer cycles. But I don't know if that means that anomaly is going to end tomorrow or a year from now, right? And I think that's the thing that everybody is trying to, at the end of the day, really wrestle with. Those that are, that have studied markets, that look at historical trends, that understand interactions of asset classes, we're all waiting for things to quote unquote normalize. And normalize just means that these relationships get back to the way they used to be, instead of these kind of strange dynamics where your risk off asset treasuries acts like your risk on equities. All right. And for individual investors, all that means is that you have an advantage over guys like me, right? Because I'm running funds that are based on a particular mandate. I can't overrule them, right? Based on my view of this being an anomaly, I can't say, you know what, I'm going to sit this out and be in cash. And even if I did say that, I don't know when then to deploy the cash, because it's always two decisions, right? Not just when you sell, but then when you re-enter a strategy or approach. So for those that have done well by being largely in cash, which a lot of individuals have, God bless. But recognize that just because you got the anomaly right doesn't mean you're going to get the next several months or years right, if the anomaly is indeed an anomaly.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.